Have you ever had one of your investments appreciate by 25 times in just 5 years? Is that even possible? Well, what I can tell you is while it may be rare, it definitely is. And in today's video, we'll be discussing where exactly this happened, when, and what we can learn from it, so that maybe we spot the next one in the future. These stocks are quite the anomaly, and identifying one would be considered the opportunity of a lifetime. One of the greatest investors of all time, Peter Lynch, describes these as 10-baggers, aka stocks that appreciate 10 times in value, and sometimes more. If you like this kind of content, be sure to hit the like button, I'd really appreciate it, and subscribe to my channel while you're at it. This is a new channel, so I'll be trying out new things to see what works and what people like, so let me know your thoughts in the comments below. Without further ado, let's get into today's video. Examples of stock growth on this magnitude are few and far between. So for this one, we'll need to go back to the 90s, to one of the few tech companies that survived the dot-com bubble. What was the dot-com bubble? Well, in 1999, the prices of tech firms soared to unprecedented levels. This was due to valuations ignoring metrics that involved cash flow and overly optimized models of future earnings. In 1994, Microsoft was trading at a respectable share price of $2.38. It had been growing slowly and consistently over the past few years. It didn't stand out from the norm and wasn't seen as an outlier at the time. However, the late 90s brought a frenzy of activity and hype to the market that hardly anyone could have anticipated. With the creation of the World Wide Web in 1989, the internet and its momentum had been picking up throughout the years, and technology companies were about to ride the wave of a lifetime. The adoption of the internet, combined with the excessive speculation of its possibilities and application, saw share prices in the tech firms skyrocket beyond belief. 5 years later, at the end of 1999, Microsoft was now trading at a high of $59.38, a growth rate of 25 times the investment over 5 years. That's a 2,500% increase. This video focuses on growth stock opportunities, but if you're more of a dividend investor, I made a video discussing how dividend investments can actually lead to significant stock growth as well. I'll leave a link to that in the top right hand corner if you want to check it out. Unfortunately, for the blue sky investors that saw the only way is up, they were to be deeply disappointed and shocked. Only 6 months later, after the dot-com bubble burst, the stock was trading at just over $31. Since then, Microsoft has maintained itself as an industry leader and is currently trading at $165. So what can we learn from this? Is there anything to take from Microsoft's meteoric rise and apply it to other growth stocks? Well, first, we need to look at the concept of the growth cycle. To capitalize on the opportunity of a lifetime, we need to harness the power of the growth cycle. These are the 4 steps that every company will experience in its lifetime: birth, expansion, maturity, and decline. In the birth stage, a company must successfully enter the market, establish itself by providing products and services to a growing customer base while building a brand. This can be where the majority of businesses fail, as they cannot capture a market share or sustain their business operations. In the expansion, this stage can vary in terms of duration, scale, and success. In the case of high growth stocks, the expansion phase tends to be rapid. So long as the product or service is scalable enough to meet the demand of the market, these firms can realize significant growth. We now know that the demand in Microsoft shares was magnified by the speculation around tech firms at the time as the next big thing. I can't imagine where we've seen wild speculation like this in recent times. The question then becomes, is what the investor paying justified based on the firm's earnings? This is otherwise known as the price to earnings ratio. This is commonly used in investing to determine whether a company is under or overvalued. In the late 90s, PE ratios soared to astronomical figures just before the burst, leading to the steep decline. The market was willing to pay ridiculous sums of money for firms based on their speculative future earnings. speculation in tech firms could have signaled that earnings were due to grow exponentially, leaving investors to believe that the overvaluation of the stock was somehow justified. This wasn't quite how it worked out. Once a company enters the maturity stage of the cycle, its growth begins to plateau. There could be many reasons for this. Demand for its products or services may not be as high as they were. They may have experienced market saturation, or they could have captured the majority of the market. High-growth companies challenge themselves year on year to maintain and exceed the level of growth they previously experienced. But at some stage, there comes a point where they reach a size that they simply cannot grow at the same rate as they previously did. Do you think Amazon or Apple will continue to grow at historical rates? Reaching maturity doesn't mean the company is doing anything wrong. But a company at maturity probably won't give you as an investor the stock opportunity of a lifetime. Where you will want to target is a firm at the beginning of its expansion cycle, the Microsoft of 1994, the Netflix of 2012. It doesn't necessarily need to be at the very beginning of the expansion. If you can attain one or two growth stocks like these as they're rising to maturity throughout your investment lifetime, you could easily set yourself up for life. As we've seen in the examples of Microsoft, Netflix, and Amazon, companies that look to radically disrupt the industry they operate in and completely transform the way we work or consume are ideal growth stock opportunities to pursue. To round off the growth cycle, we reach the decline stage, where the demand in a firm's products or services declines such that it loses market share. These firms grow to such a scale that they are prone to inflexibility, leading to a lag in their ability to adapt to trends or innovation. It could be that the very growth stock we've mentioned are disrupting these industries, rising rapidly through their expansion phases and putting the big-time players out of business. Can you think of any examples? So that's it for today, folks. Thanks for tuning in. Be on the lookout for a firm's PE ratio the next time you invest and think, can this firm really project a significant earnings growth in the next few years? Is this an accurate valuation of the stock? Let me know in the comments below what stocks you think have the potential to be the opportunity of a lifetime. If you're enjoying the content, be sure to hit the like button to let me know. Remember to subscribe, and until next time, see ya.